as you all have been waiting for. None other than Disney earnings. We've been waiting a while for this. We want to see some good stuff, okay? Not only as a Disney shareholder, but expected some good numbers here. After hours, you see a downward move, down close to 4% right now. So, obviously, main thing to consider here that investors are looking at is going to be subscription data. So, my assumption is you might have seen potentially there was some negative news in terms of that, which I find shocking. I really don't see how that could be possible, given the slew of original content and how quickly these subscriber numbers are growing for this company. But we'll see what it looks like. So just to put it into context, as we do with all of these, if you look over the last year, the stock's seen some favorable return, up around 70%. Quite significant, honestly, for a year's return. Can't lie to you. So there's room for pullback, absolutely. But I think a lot of that return was justified. If you look over a 5-year period, definitely some stagnation within this stock. From 2017 to really through 2020, there was just a period of just no movement here. 3-year period where you just see little movement. So I think that's where part of the rise came from here. But obviously we see some downward movement. Let's take a look at these earnings, okay? So non-GAAP EPS of 79 cents beats by 53 cents, and a GAAP EPS of 50 cents beats by 44 cents. Quite a significant improvement in terms of profitability. Definitely was the concern with this company as the parks segment was completely shut down. So, interesting stuff to see there. But profitability beat is exciting to see. Now the revenue line kind of disappointing. $15.61 billion, down 13% year over year. It missed by $320 million. I'm shocked that this company missed the earnings estimates. I really am in terms of revenue. I didn't think they'd miss them. And you look here, Disney Plus subscribers came in at 103.6 million versus 109.3 million consensus. I expected 110 million, and I have, I'm not gonna lie to you, I had it on record. I expected a 110 million number. So I'm kind of shocked they didn't necessarily hit it in this aspect, seeing as they hit 100 million really a couple months ago. So I expected a little bit better, I can't lie. Still unprecedented levels of growth in terms of subscriber numbers. It's incredible still for regardless. You'll see the quarterly growth. It's going to be pretty significant, so we'll look at that obviously too. And ESPN Plus, they headline that here, which we'll look at in depth. Came in at 13.8 million compared to a 13.4 consensus, so at least that beat. Curious what the Hulu numbers look like. So again, that's why the stock's down, no doubt. But obviously shorter consensus. Streaming did not mitigate park losses as much as expected, as we saw. Profitability measures by contrast came in ahead of expectations, no doubt. EPS rose 32% to 79 cents. EPS from continuing operations rose to 50 cents from 26 cents. So one thing to mention here too, as far as the revenue line, because you think it's compared to a quarter of a year ago where they had obviously open parks, or you might have thought closed parks because, well, it's against a pandemic quarter, but it's not necessarily that way. So you see a 13% decline, but you have to consider the fact that 2 months out of this quarter, around maybe 1.5 to 2 months out of this quarter, the company still was operating their parks at full capacity. And to see only a 13% decline, I think I kind of take as a win in this aspect. Absolutely. Disney Plus subscribers hit 103.6 million. In line with investor expectations, though analysts were expecting closer to 109. So analysts, you guys are bums, okay? I'm not calling myself a bum. The analysts are bums. So obviously that's got all the big hedge fund investors. They're pulling out of this stock. What's going on here? By segment, Disney Media and Entertainment up 1. Parks, Experiences, and Products down 44. Again, that is where you see the significant impact there. Obviously, next quarter you're going to see a significant upward impact, as even at partial capacity, they'll be doing way better numbers than they did, in the quarter in which they were completely shut down. So, yeah, absolutely. Let's look at the press release, as we like to do. We love a press release in this house. I very much like a press release, okay? Don't you tell me I don't. If you look, obviously, quarter end, down 13% as we saw. But from a 6 months ending standpoint, down 18%. I got to be honest with you. I'm not really all that upset with that number. To be down 18% on the 6 months ending period, when you're comparing this, think about the fact that entire, at least 5 out of the 6 months for last year's quarter, they were entirely open. I mean, good grief. And see an 18% decline only, they're doing some good stuff to make up for that, really. Net income line coming in at 912. Could be better, 912 million. But all things considered, not that bad. That compares to obviously the year ago quarter, only brought in 468. So, and that was again with them being open for 2 months out of the quarter. And obviously, what's been soaking up a lot of that profit line has been Parks and Rec. There's no doubt about it. The upkeep, as well as staffing, has been soaking up a lot of that operating income, really. Segment results, baby. We love it. We love to see it. Give me the breakdown. Oh, yeah. That's the breakdown we like to see. Quarter end, obviously we saw Disney Media and Entertainment Distributions. Slight 1% increase. Yeah. Not too crazy, but we'll take it. And Disney Parks and Recreation, down 44%. And a 6 months ending standpoint, down 49%. Yeah. Now, so here you'll see they combined all the media, entertainment, all that together. One thing you need to consider, you see only a 1% growth there. I'm not too unimpressed with that because you consider the fact that this includes movie theaters, which they have not had had an opportunity to release any movies really in theater in a while, right? And it's few and far between. They haven't had a massive movie released in theaters in a hot minute. So that'll obviously change as we go into the future. And you go against some really weak quarters. The comps are going to be pretty good in the next quarter onward. Here's a breakdown. Linear networks down 4%. Not too crazy. Direct-to-consumer, that line was up 59% still. 59% growth in terms of the direct-to-consumer category and or streaming. Content sales licensing down 36. Not too crazy in terms of that aspect. Linear networks, nothing super crazy. Down 4% both in domestic and international channels. So I'm not too crazy about that. We see the direct-to-consumer bill. That's what we like to look at, okay? We like looking at direct-to-consumer. Operating loss, first off, decreased from $0.8 billion to $0.3 billion. So you see significant strides towards profitability in this segment. And really, this will be a very soon to be segment that is a profitable one. Even with the creation of a lot of unique and diversified content, they're making it all. Exclusive content, still able to bring in a nearly darn profitable line. So I'm pretty impressed. This is going to be a profit machine for this company down the road at some point. So, breakdown of subscribers. You see, obviously, 103 million in terms of subscribers. That compares to a year ago, only 33 million, right? And obviously, this program was only around 6 months old at the time, but it's crazy to see how much it's grown. I mean, it's incredible. We're talking about a 3x number there. Quite significant. ESPN Plus up 75%, 13.8 compared to 17.9. Really nice to see that. And Hulu, both segments grew. 31% growth in the streaming VOD only, 37.8 million compared to 28.8. And even live TV came in at 30.8 compared to 30.3, a 15% increase, which is significant. The live TV portion of it, obviously, huge profit getter for them. But we're talking about a a switch from cable that is eventually taking place. People using this as an alternative way to view programming. So, total Hulu up 30%. I think is pretty impressive, in my opinion. Revenue per paid subscriber did decrease 29% on the Disney Plus segment. Not a shocker as you get more subscribers. Each subscriber technically can be worth less because it depends on whether they're free subscribers, if they're paying for movies, so on and so forth. But in the other segments, they did show an increase. So you like to see that. Overall, the streaming numbers I like a lot. I really do. From a Parks and Recreation standpoint, domestic and international both seeing significant decrease. Consumer products, though, up 13%. Think about your Baby Yoda merchandise, okay? People are still buying it, okay? And I would too. But again, you need to get the parks back open, which they will be. And some already are, so we'll see what that looks like in the next quarter compared to a really weak quarter. So I'm excited to see that. I do want to look, obviously, at the balance sheet, as I do. You know I love the balance sheet. There are a few people that love a balance sheet more than me. I mean, it's a thing of mine. I mean, you can shame me for it all you want, but I won't shame you because you like looking at pictures of feet. I might shame you for that. So, just being honest with you. 6 months comparison for this balance sheet. I like it. I prefer a full year, but 6 months will work. Total current assets coming in at $32.8 billion compared to $35.2 billion. So a slight decrease there in the cash position. Total assets in general coming in at $200.2 billion compared to $201.5. Very slight decrease in terms of total assets for the last 6 months. Not too shocked there. Total current liabilities coming at $26.6 billion compared to $26.6 billion. Very slight increase. Not too bad. Not too bad at all. Now, we see overall total stockholder equity has risen, baby. So a little bit of a decline in long-term debt here. $89.7 billion in equity compared to $88.2 was just 6 months ago. So you're seeing growth here. This balance sheet is really in good shape for where the company's at, especially after going through a pandemic that completely hampered the biggest part of their business. The largest part of their business got completely hampered by this. I'm impressed, all things considered, to see the stock trade at a market cap of $323 billion. I think is relatively cheap. I mean, you're talking about a company this year, most likely. Let's say they bring in, I think with Parks and Recreations opening back up, we're going to be talking between $80 and $90 billion. And they're trading a market cap of $323 billion. I think that's darn cheap. I mean, we're talking about 4 times that value. It's pretty darn cheap, in my opinion. I like it. I like what they're able to do there. I think this is a company worth buying at this decrease of 4%. I like the purchase. Again, it's hard to justify buying it when I have my shares at $90 a share, but I just like the company right now at these levels when you're talking about the future of this company with streaming, and they get Parks and Recreations back this year. As the CDC just announced, maskless life for those who are vaccinated. We're coming back, baby. We're coming back with a vengeance.